Somebody's about to punch the air. Oh, you son of a bitch. I was trying to fade ICT. Fuck him. He's a fraud. I can't show the video now. It failed on me. Fuck you. Fuck you very much. Woo! Give me some more ICT. I'm here all week, baby. Tip your bartender. Tip your fucking bartender. Who's doing it like this, Patrick? Come on, baby. Get the fuck out of here.
Does this person sound like a professional gambler? Or does he sound like a total degenerate who is excited about his call playing out? A professional gambler is someone who has complete control over the time, money, and energy they spend on gambling. They are seen to be more skilled at gambling than other gamblers and are considered at a low risk for addiction. I don't know about you, but ICT doesn't strike me as a professional gambler. He strikes me more as a emotional degenerate that finally got a winning trade after losing multiple times. And I believe that ICT is slowly going insane with each year passing by where he promises to win Robin's Cup but never does. And I put out this amazing tweet recently on my Twitter. If you are trying to explain every single pivot in the market, you are going to go insane. Focus on taking a piece of the market and go touch some grass. Which is, I believe, the best trading advice that anybody can give you instead of trying to figure it out every single move in the market. And most traders intuitively know this, but yet most of them fall into the trap trying to predict every single move in the market, and it's just not possible. Here, I will let you watch the OG Mark Douglas.
Is so that you understand with no uncertain terms that there are a whole category of traders out there, people out there, traders, people who have both the financial and the psychological resources to bid markets up and offer them lower. And what's the point that I'm making? The point that I'm making is that any particular technical methodology that you use to determine a pattern is present that gives you a higher probability of one thing happening over another, until you can get into the minds of the people who actually move prices, you will never know for sure what's going to happen next. The only people that know for sure are the people who are willing to do it. And that's what you got to burn that in your brain. You will never know for sure what's going to happen next, unless you can read the minds of the people who are going to do it. And there are people who will do it. And they do it all the time. That's the only way you end up in a winning trade. Most of the time when you end up in a winning trade is because of what these other dynamic traders are doing. So to convince you that there are people who are willing to do this, if I'm a hedge fund manager and I've got to unload, a huge position and the market happens to be sitting right here in relative to this chart pattern, how might I maximize my profits? What might I do? Now remember, I've got to sell. I'm going to be a seller. But what might I do to make sure that I get the best price? What?
Drive it up and sell it.
Yeah, drive it up. In other words, I will do the opposite of what I want to do to get a better price. And I will drive it up. But how much risk am I taking by doing that?
Probably not a lot. If you sell it just a little, drive it up, and sell a bunch coming back down.
Well, yeah, I mean, if I drive the price up by taking out these offers and then bidding up, taking out an offer, in other words, I can look with depending on the kind of software I have, I can find out what depth, the depth of the market, meaning that you know, and I'm not saying these are hard offers because people pull their offers all the time, but I can look at this, I can look at this high and I say, you know what? How much money might it take for me to drive the market from here to just past these highs right here? How many offers do I have to take out to do it? Just tally it up and see if you want to spend the money. Because in essence, how much risk are you actually taking? See, by driving it up, what you're doing is you're increasing the asset value of your portfolio. So in that sense, you're not taking any risk. You're actually making money. If I continue to drive the price up, I am actually making the trades that I made down here winners. Every tick that I drive the price up, I'm making myself a winner on the trades that I made at lower prices. To actually drive a price up because you are making yourself a winner at the prices that, what you bought at lower prices. If, for an example, by me driving this price up, it draws other people into the market, that will help, will it not? Because it creates more of an imbalance. Now, that's the real thing. What I want to do is I want to get more buyers into the market. And the reason why I want to get more buyers into the market is so somebody is there to take the other side of my sell orders. Because that's ultimately what I'm doing here. What I'm doing is I want to sell. So what I'm doing is creating a bigger pool of orders to come into the market till I can sell into, so that my sell orders don't drive the price down. And so I will purposefully do the opposite of what I want to do, ultimately, with respect to my position. Now, the reason why I'm selling has nothing to do with this chart pattern. Absolutely nothing to do with the chart pattern itself. I'm just using the chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time. And so the point that I'm making is that you're trading off of a mathematical formula. Literally, and this mathematical formula, what technical analysis does is it gets into the collective mind of the market. In other words, every tick, every uptick and every downtick is information. That information is accumulated and mathematical principles are applied to it. There are actual patterns that emerge, that repeat themselves over and over and over again, that you can identify with mathematical formulas or with these visual price patterns. But the problem is that there's no mathematical formula that can get into the mind of the individual traders who actually are driving prices up or offering them lower. But if you don't know that, you somehow or another, if you're trading on a smaller time frame, and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do. And you do it just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because that your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market. You hear what I just said? There's almost no reason that you will come up with to put on a trade that will ever correspond with the actual reason why the market went up or the market went down, other than the fact that there was an imbalance in conviction between buyers and sellers. Because the people who do this will not tell you unless it's in their best interest to do so. And the reason, the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say.
Or to disprove what they say.
That's right. There's no way. The only people who can do it are the people who actually made the trades. The only people who know for sure what's going to happen next are the ones who are willing to make it happen. You see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. On a trade-by-trade basis. They will tell you what will happen. Let's say, I don't want to use the words to happen next. They'll tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that. If I limit my risk when I take the trade, and my profits, my profit potential is at least 1 or 2 or 3 times greater than what I need to risk, then over a series of trades, I will be a consistent winner. That's what trading is all about, guys, as a passive technical trader. Unless you're doing this other stuff, I just said it right then and there. I said it all right then and there.
Rest in peace, Mark, but he did say it right then and there. What makes you think that you can predict every single move in the market when you have no idea what the people who have financial and psychological means to move the market are going to do next? You simply can't. That's why less than 1% of these traders make any significant returns consistently. Let me zoom that in. That's way on top of the pyramid after everybody quit. After years and years of unprofitability, there is only less than 1% of these traders make any significant net returns consistently. And they are not doing it by knowing what market will do next. They are doing it by executing the same trading model over and over again. So if we can't control the market, what can we control? We can only control ourselves. This is why I keep emphasizing to follow your daily plan and execute the same trading model over and over, because that's how you will conquer trading and conquer yourself, so you don't act out like this.
Somebody's about to punch the air. Oh, you son of a bitch. I was trying to fade ICT. Fuck him. He's a fraud. I can't show the video now. It failed on me. Fuck you. Fuck you very much. Woo! Give me some more ICT. I'm here all week, baby. Tip your bartender. Tip your fucking bartender. Who's doing it like this, Patrick? Come on, baby. Get the fuck out of here.
The only solution is to let go of the desire to be right and accept that losses are part of this game. When you learn to let go of the need to be right, being wrong gradually loses its power to disturb you. And really, the only certain thing, that certainty does not exist, and this is life in general. We must become comfortable with risk, because if we are not taking risks, we are not improving, and if we are not improving, we are falling backwards. The real secret to trading is to become indifferent towards the outcome and treat trading as a job where you come in every day, executing your daily plan and moving on with your day. Adopt the belief that current trade most likely will not work out, because that's the only certain thing, that's the only guarantee that we have as traders, that as soon as you put the trade, it's already a loser. So it's the only one guarantee that we can rely on as traders, is that we are starting with the losing trade. So most likely this losing trade will not work out. So this belief allows us to adopt the mentality of placing a stop order, protecting our risks. So we don't go acting like total degenerates, increasing our risk because we feel so great that we can predict the next move. And we can't. So it's unrealistic and delusional to think that we can win every single trade. It's just not reality. We need to adopt the belief that current trade most likely will not work out. And that's the only way to be indifferent towards the outcome. That's the only way to be indifferent and stay emotionless while we trading. Because as soon as we get excited about trading, we start believing that we are invincible. The dopamine and adrenaline feels very good, and we start doing crazy things. We start leveraging up, we start taking more trades than we should, and pretty much we are not following our daily plan. And if we can control our market and we can control ourselves, you can imagine what kind of outcome we can expect. And the only belief that we can have is that our trade will not work out. And we can only rely on the series of trades. But those trades need to be the same. So we know that our methodology, our pattern that we're following are working, because over series of trades, we come out as a winner. And if we come out as a loser, then maybe we can try to trade some other trading strategy. Or maybe trading is not for you. Again, we cannot have trading as the number one priority in our life, because we cannot rely on it. Trading is gambling. You either like it or not, trading is a risky gambling behavior where we're placing bets on the direction. And as Mark Douglas says, there is no way of knowing if our next trade will work out. So might as well, we need to adopt the belief that the current and the next trade will not work out. And we simply placing bets, and over the long period of time, we hopefully come out as a winner. So trading cannot be the number one priority in our life, because that's a recipe for disaster. So really the only way to trade is the mechanical trading. And really there are 3 levels of trading mastery, but you gotta start from somewhere. You gotta start from mechanical, then you can move on and add on more confluences and try to tweak your trading models, and then your trading become more subjective. And then eventually you can trade intuitively, but you have to start from the mechanical strategies. And most people don't. Most people never master the mechanical strategy, and they never master their emotions, and they keep on in that cycle of losing, refilling their account, and keep on going in that vicious cycle of trading madness that, like you see in the beginning of this video. But the real secret is to have one trading mechanical strategy. So in this video, I want to present to you the simplest mechanical trading model, where we're using a simple Fibonacci retracement and entering at the golden pocket, which is the golden ratio 618 retracement, and our exit is only TP1. I recommend you take off your whole trade, because a lot of times if we wait for TP2, we might have a deeper retracement and we might get stopped out at the break even or whatever. But if you want to keep it the most mechanical as possible, I recommend number 1, limit order at 618. So if we can identify the bullish trend where we break in structure to the upside, what we want to do is we want to measure this leg over here. This is the expansion leg, and we have waiting for this retracement to the golden ratio to the 618, where we set the limit order. Our stop loss goes below this low. This is protected low. If you don't know what the protected low is, watch my videos about market structure, you will understand. But I continue to simplify trading, and the only way for me to succeed at trading is to completely remove the thinking process, completely remove the desire to be right. So this way, I know that most likely this trade will not work out, but over the series of trades, I might come out ahead because this pattern plays out in the market over and over again. And I'll show you examples a little bit later. And all we have to do is place a limit order at the golden ratio 618 and place a limit exit where as soon as price gets to this level, we take our profit and we are done for that trade. Again, I don't recommend you waiting for the TP2 because most likely or not, there's going to be some kind of retracement before hitting these highs. And in a lot of cases, we might not even get the TP2. And I rather take profits and have a winning trade than see price reverses on me. And in my previous video, I was talking about the daily plan. This fits perfectly within the daily plan where all you have to do is just find few trades like this every single day. You can go to the low time frames like 15 second, 1 minute, and you can find many trades like these. And all you have to do is just execute from entry to the TP1, take few trades like that, and move on with your day. Let's go through some examples. I have a NASDAQ 15-minute chart. As you can see, there was a reversal here. We have double bottom in here, and we have this expansion upwards. This is where expansion ended, and we keep on dragging our fib. So first we drag fib to this high, then we dragging fib to this high, then we dragging fib to this high, and we waiting for the price to retrace into our entry where we have a limit order. So as price going up and not retracing down into the 618, we keep on waiting, and this becomes liquidity. This becomes people that are longing here. They're going to be stopped out on this move down, and we can enter at the 618, and it's easy exit over here. And as you can see, the price actually went to TP2. But again, I recommend it for the completely mechanical strategy. I recommend exiting at 0.236, which I believe the most optimal exit for this strategy. And again, you should go and backtest and see it in your chart, see it how it plays out, get used to it, and then you will be able to just set limit orders and be done for the rest of your day. Here's another NASDAQ 15-minute chart where we have a break of structure here, and we're waiting for the price to come to the 618, and we have an exit at 236. So our measurement goes from the low to the high, and you can simply put the limit order at 618 and wait for this 236. And as I said, sometimes this is a perfect exit and you are done. You don't have to be waiting in this retracement over here. Here's a bearish one, 15-minute NASDAQ again. We have this expansion leg down, which we measure with our fibs, and we wait for the retracement to the 618 and exit at the 236. And it's quick and easy trade, and we are done. And again, based on your daily plan, you can have a daily plan where you just take one trade a day and you're done. Here I have gold chart. Again, we have break of structure here to the upside. We have a leg from here to here. We measure anchoring our fibs from the low to the high, and we're simply waiting on this pullback at 618, and we exit at 236. This is a gold hourly chart. So as you can see, again, as soon as it taps into the 618, it goes to the 236 and starts pulling back. As you can see, these wicks. So I believe this is the most optimal trade over here. And while most people are waiting for the draw, we are already done with our trade. And it's all about risk management. So depends on your risk tolerance, whatever you want to risk, either it be $100, $200, you need to calculate how much you want to buy over here. So you are risking $100, $200, whatever your risk tolerance is at the stop. And 236 is the 1-to-1 risk to reward ratio. So based on your risk and based on your size of your account, you want to calculate how much you need to buy over here so you have a 1-to-1 RR. A 1-to-1 risk to reward is the great start. If you want to improve, go back test this, see what happens, how often we get to the take profit 2, because that's the only way for you to gain confidence and experience in your trading. I cannot teach you that. You have to go into the charts and execute and see this happens. But remember that you gotta execute the same thing at least over the series of 30 trades, at least that, and see what kind of win rate you have, what kind of risk to reward you're comfortable with, and see how this plays out in real time. You're only going to get that through backtesting and forward testing and live executions. Here's the daily chart on Bitcoin. The same thing, we had the break of structure here, and we're waiting for the pullback. There is our high, there's our low. So the low is the stop. This is the invalidation here, the stop. And our entry at 618. And as you can see, we've been rocking back and forth. And eventually, we got down to the 618, swept this low, and now heading almost got to this TP1. So this is the most simple trading strategy that I can come up with. And really, that's the only thing that you need in trading, because if you can have a limit order entry at 618 and exit at 236, you don't have to think about it. This is the most mechanical thing that you can do in trading. And once you can master this, once you can consistently execute your daily plan, which is how many trades you want to take every day, right? You do that daily plan consistently by executing the most mechanical strategy ever, which is entry at 618, exit at 236, and over time you will build confidence and you consistently will see the results of your trading. Because if you are just going into the market and trying to read it and trying to predict this move and that move, and you taking trades randomly, you will never know what your trading will look like over the long period of time. And the only way to know that is to execute the same thing over and over and over again. And I did not switch the strategies. I didn't hop around or anything like that. All I did is simplify further. Here, if I go back to this gold chart, there is an SBS, the swing breakout system that I talked about in my previous video, which is, there is our breakout here. We have 1, which is the breakout, 2, which is the first step. We have number 3 over here, and we come back to liquidate the first step over here, right? We liquidate that first step. That's number 4. We have a reversal. That's number 5. And our target is over here, which is 236 instead of TP2. So I refined the SBS even further by not letting myself wait until TP2. So I noticed that most of the time we reverse or we pull back right before the exit at TP2, which is number 6 if I'm talking about SBS. I realized that and I was like, well, why not just take 1-to-1 RR? Why not take a entry here and exit here, which would be the most optimal, I believe. Here's another one, 15 minutes, right? We have a breakout. We have number 1, which is the breakout. Number 2, the first pullback, the first stop. Number 3, right? And number 4 liquidates and taps into the 618. Now we had a deeper retracement, but we're not panicking because our stop loss is over here. That's why our stop loss is over here. So because I don't want to think about it, I just want to place a limit order without being emotional, without stressing about it, and I want to exit quickly, right? So we have a reversal here, and it goes right into the 236, and look what happened. Pullback. So do I want to take profit, or do I want to wait maybe for this TP2 over here, for the number 6 SBS? So what I did, I refined it. And I simplified my execution even further. So this is how it looks like. And let's call it golden SBS because it's a golden pocket, 0618. And like I said, we have a breakout, 1, 2, 3, 4 liquidates number 2, and number 5 is reversal. We have a limit order at the 618, and we have a TP at the 236. And that's it. That's the model. That's the most mechanical model that I can come up with. And this is really it. Without SBS, the SBS is a great confluence for this model. So with that being said, thanks for watching. Go backtest this model. Share your thoughts and questions on Twitter at StoicTA, or ask your questions down below in the comment section, and I will see you in the next one. Good luck.